Welcome back to the Compassionate Capitalist Show. And today we are going to be talking all about opportunity zones. And for you out there, some of you are going to know exactly what I'm talking about. And then some of you are going to go, what is that? And then some of you are going to go, oh, that's this other thing. And we're going to clarify all of that. It's the why, how, and what for those that this is new news. Okay. Because I tell you, when the opportunity zone first came out, there was a lot of confusion. I would go and talk to people and they would be like, oh, hub zones. Oh, is that like new market tax credit? So I'm going to clarify all of that. And I'm going to I have an excellent guest on the show. I'll be doing a full introduction here in just a few minutes. But for those that are watching on YouTube, Landon Johnson from CapZone Analytics is my guest today. And there's, almost all the time when there is a government change, a government tax law, they rarely get away with not having a lot of regulations and compliance. And opportunity zones apparently had quite a bit. There was a lot of confusion. The funds from doing those projects, there was a lot of confusion for a long time, for about all around it, right? We have now been in it for a number of years, and there's new regulations being proposed and new compliance. So timing is perfect to hear from Landon and hear what the solution that CapZone Analytics is bringing to the table to solve this problem for the investors that are doing opportunity zone projects. So let me give you the why, how, and what, so we're all on the same page, okay? Because for those that are involved in it, either as a fund participant, investor, fund manager, developer, where the real rubber meets the road, compliance, there's a whole lot of complexity to the opportunity zone fund tax code, with deferral and reduction of capital gains from the shift in investments for the ongoing income, the stair steps of tax offsets by the length of the investment, the difference in real estate development versus operating business acquisitions, all of that. It's very complex. And as I said, I have an excellent guest, and we're going to share the red flags that you need to be aware of, solutions to make sure you don't end up paying big penalties rather than reaping these huge rewards. And, before I go into the full intro for Landon and bring him on, I want to get us, like I said, all on the same page. So for a long time, our federal, state, and local governments have worked to offer incentives for businesses to set up in areas that had become what we call economic deserts. So how we got there. Over many decades, starting after World War II, inner cities were redlined so that not as financially viable. There was more perceived risk associated with certain areas, which made it very costly there to get a loan, or if a loan was offered, you would have to come to the table with a huge amount of your own capital, like sometimes 50% in the need. Interest rates were very high, and the effect by most economists would be predictable. But, based on the risk management tables, banks elected leaders didn't really care that the residents couldn't purchase homes, fix up those homes, start a business, buy a business, get a business loan. The ripple effect over many decades was that there was little to no investment made in these areas. Homes were left to rot and decay. Local governments could easily use eminent domain to acquire the land that they needed to build a highway, to cut through the community, cut it in half, or build an airport or major sports stadiums in those communities. Schools evaporated, left vacant because of declining property taxes that could not sustain those schools. Small businesses like a corner grocery store left because there's no customers to sustain them. No hospitals in those areas. All of that stuff. And you have driven through those areas in your in-town communities, inner cities, all that kind of stuff. And you've been in those areas. You've been in those areas and you've been, how do I get out of this area? Because you took the wrong turn off the highway. We've all been in those kind of areas, right? That, just economic plight, and also often crime ridden, because that's the only economic opportunity for, people that were stuck living in those areas because they couldn't live anywhere else. So redlining was made illegal in the 1970s, but you can imagine the effect that lingered on, because it's really hard to turn the tide of attracting investment. It's hard when, you have decay in these areas. Yeah. And even though it wasn't legal, redlining still was a practice by major banks right up until 2017. In fact, I was at an Opportunity Zone Incentive Program kickoff meeting, and it was passed in 2017 by the 115th Congress as part of the Tax Cuts and Jobs Act. But I heard directly from a bank exec at one of this kickoff meeting that prior to this Tax Cuts and Jobs Act, that this bank that he worked at was still doing redlining in that area, even though it was illegal. It was an informal program, right? When they go into the underwriter's office and say, what's the risk of this loan? And they would, the terms they might give that loan versus this other loan would be different. Right. And so in these areas, local governments and the federal government started to do things. They would call them hub zones, and that stands for historically underutilized business zones. And this is where sometimes when I would say, opportunity zones, people would think I was talking about that program. So part of the complexity and the slow adoption, and you're going to hear some stats here in a few minutes, of this new opportunity zone incentive program was confusion by some of the institutional investors, some of your local real estate investors, a lot of different people about hub zones. Okay. And they were confused for a bit about hub zones. So at my capacity, first conversation was always comparing the difference, right? And so hub zones they would offer tax credits for each job created. But the problem is that the business owner had to invest in the business and ramp up and do all of that. Again, not getting other financial incentives and low interest loans to be able to do that. They would get this money, though they would give them tax credits. And there was also 3% set aside of federal contracts to go to businesses in these hub zones, trying to encourage, economic development, but very little actual impact because of the little private and institutional money would be put towards that effort. I mean, you think about it, it'd be, if you could choose where to develop, and you have, $10 million, $20 million to develop, you could go someplace and you could put 10% down and get a low interest loan, or you'd have to go and put 30% down and get a high interest loan, and you might get some tax credits back, but that's down the road. You would choose to do this other, all things being equal. So they also started programs like the state small business credit, SBCI. They had SBIC, small business investment companies, that would get loans from the SBA, from the Small Business Administration, that would co-invest in things that private equity funds or venture capital funds, institutional money, would put in to these things. And you also had new market tax credit programs that were similar incentive programs for institutional money to provide debt capital to businesses to relocate and come into these hub zones. So lots and lots of government, federal money, our taxpayer dollars, being put towards these programs with the goal to increase jobs and investment and redevelopment in these types of things. They had effect, they had impact, but nothing compared to what happened with this opportunity zone program, right? Because it was tax dollars, businesses already there. It was, not an incentive. So what it also ignored was rural communities that had become victims of deindustrialization. So manufacturing plants moving from rural areas to build modernized plants with robotics and things like that, and take advantage of tax incentives that other states, these competitions that states would do. They would not be hub zones or anything like that. They would just say, come here. We're not going to charge you for your income that you do if you put a plant here, or a call center here, or whatever you're going to do that's going to create jobs in this area, right? So two senators, Cory Booker from New Jersey and Tim Scott from South Carolina, had been working on this, and House Reps Ron Kine from Wisconsin, Pat Tiber from Ohio. So you had Republicans and Democrats working together on this because they recognize the common problem, right? And that I talk about all the time, right? I actually have a cartoon or a diagram I created in my book that talks about how money is a living thing. In my book, Inside Secrets to Angel Investing, if you're watching, you can see me point over my head. That money is like a living thing that migrates to where it can reproduce. Money likes to go where it can make more money. It likes to make lots of baby money and stuff like that, right? And so that's what we've seen where investment goes and this kind of stuff. And so what they realize is that if they took the burden off of small businesses and the government to create the opportunity to be made by investing in both inner city and rural areas and unlock the capital gains pent up in the stock market, and with many family offices and real estate developers that had been deferring capital gains for decades through the Section 1031 exchange. If you're not familiar with that, that basically is a program that allows real estate developers or real estate investors, when they sell a property, if they go and invest in another real estate property, development property within, I think, 6 months, then they don't pay any capital gains on it. The local term is kicking the can down the road. They kick the can down the road so that they can not pay capital gains, and they put it off to a future generation to do this, right? So this has happened for many, 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 many years. So they recognize that there are, these investors that would like, because the demographics has changed, they might want to be able to get out of one project and go put it into another project if they gave them incentives. And so the incentive was rich. So instead of taking taxpayer dollars to fund this kind of stuff, what they would do is that we just won't receive taxpayer dollars. We're not getting it anyway because it's being kicked down the road, or it's tied up in these things where people are just letting their investments ride. And so the government wasn't making any money off of those anyway. So what we're going to do is give them incentive. And now the government doesn't have to be responsible for developing and trying to do what is needed in these areas. Let the people that know how to do real estate development, know how to build low income homes, know how to turn around businesses, let them use their expertise and their money to go do. So let capitalism thrive in the areas where we need economic development. So they would take, they had a time frame on it, right? So it passed in 2017, took a whole year so the government, so all 50 states, including our U.S. territories, were able to designate up to 25% of their area, of their entire state. So it didn't have to be these old hub zones. It could be rural areas, anywhere where there was low income, and just a census tract measurement of that. And so they could designate this. So 8,700. So it took them, they had to give an extension. It took them almost a full year for these states to come up with this area. And they reached out to their local municipalities and say, do you have any areas that you want to submit? So it was very much an equal opportunity thing to do. Like in my place, Fayette County said, no, we don't have any low income. Stupid. Sorry. Just they were. So we don't need any of this incentive. Whereas our Carroll County, where Noonan is, right over the borderline, they took one of their entire areas where a new hospital was being built, and there was an old downtown and old commercial development shopping center and a whole bunch of land not developed. So, and they put that entire thing into the opportunity zone. It's amazing the stuff that's happening down there, right? And so it took almost a whole year for that. And then they added this thing about business piece to it, that it took a while for people to figure out how you develop in business. And they added the thing that says existing property owners didn't have to sell their land. They could share in a project, where they couldn't get development money to develop something there. Now they could. So they were changing the rules in that first year, and there was a whole lot of figuring stuff out. But in that time frame, what you had was 8,768 zones in the 50 states and 5 U.S. territories were established. By 2020, so really kind of 2 years after it took effect, 48% of those communities had projects and investments underway, compared to 18 years of new market tax credits in these hub zones to get to 48% participation. That is a profound impact for this, right? 48 billion has been invested by the end of 2020. That's just the numbers I have. So obviously it's a lot more since then, because people have really started figuring it out, even though the stair step, so the capital gains of that first capital gains money that you would have paid, and normally I think it's 35%, you would have a 15% reduction of that capital gains that you would have to pay, but you didn't even have to pay it right away. You could defer the capital gains that you would have. So you sell a project, you have let's say you have 100 grand in the stock market, and you would have had to pay, and you had 35%. I can't do the math on that, but whatever, the 35% on that piece of that, I was like on the top of my head, I was going to give an example. I should have written it down. Anyway, you would have had 15% of what you would have paid, you would never pay if you held on to your opportunity zone investment for 10 years. And so that other 20% you would pay at the end, and at that time when the clock ticked off. And then if whatever you made during that period of time, no capital gains on it. Okay, if it stayed into this qualified opportunity zone piece, right? So you had a stair step complexity of a tax thing. You have different types of projects. You now have people coming into it all this time, because now, we're 2023 and there are still projects being done. They don't have that initial piece of it, but they still have the tax deferral. And now there's new proposals for compliance and regulations and oversight and audits and things being introduced into that. So, Landon Johnson with there he is, right? So he's going to, I'm going to introduce him now, and he's going to tell us about how compliance can be the secret killer, where it's so important to protect your investment by identifying compliance issues early and avoiding legal and financial penalties altogether, tracking those issues, regular reporting. And when it comes to raising funds, because people are still raising funds, getting investment grade due diligence and compliance through the kind of programs that they offer to limit risk factors for those future investments. So Landon, here he is. Landon has spent his career working with hypergrowth technology companies, helping them optimize their marketing, sales, and go-to-market operations. And for the past 25 years, he's been anchored in the leadership of his management consulting firm, Talent. Along with the way, Landon stepped aside to run a few ventures, including launching a cybersecurity software startup that was sold in 2019, and then now acting as a chief revenue, or he was acting as a chief revenue officer at Clark Construction, performing in his current roles as chief marketing officer at CapZone Analytics. He's built the only tax platform for the opportunity zone financial sector, and he lives up in Maryland with his wife and some college-age kids. Loves action and fitness related stuff, and he's a master of dad jokes. It's even on their website. So maybe we'll get one of those before we're done here. You can find him at LinkedIn under Landon Johnson, and on Twitter, it's Landon KJ. And the website for CapZone Analytics is capzoneanalytics.com. CAPZONE analytics.com. So there you are. Welcome, Landon. Did I set the stage good there? Did I explain the history well?
Thank you for having me. I think I need to take you on the road with me, Karen. I learned a few things. That was amazing. So clearly, both you've done your research and this is of interest to you. So that's wonderful. You set a perfect backdrop for what should be a fun conversation about where the OZ market is, where it's going. And I know that your audience is includes a lot of alternative investors. Even we can even talk about how they can get into it, when they should get into it, and maybe dispel a few myths. We can get into all of it.
We will.
We will for sure.
Okay.
Where's a good place to start?
Well, but first, let's fill in the gaps, because CapZone Analytics is a fairly young company, and you probably had your choice of things to do. Did you have a background? I mean, you were in the construction, you had been in the construction side, but did you have a background in real estate development to kind of see this in the horizon and say, hey, that's a good place to kind of go, hang my flag and even the founder of it, realize getting into the compliance side and because so just fill in the gaps for the audience, and then we'll get into more stuff.
Sure, happy to do that. So CapZone Analytics, we are ourselves a qualified opportunity zone business. So we are operating within the opportunity zone program, funded by a qualified opportunity fund. One of the founders, the founding team of the Qualified Opportunity Fund, our primary funder, CapZone Impact Investments, is a gentleman named Al Puhala, who has been an incredible advocate and visionary for the Opportunity Zone program since the earliest of days. So he started one of the very earliest Opportunity Zone funds back in 2017. You mentioned that this was kind of tucked into, almost snuck into the Tax Cuts and Jobs Act as just a few paragraphs of the bill that then grew into the full law. He was one of the architects of that original vision, and then he has been a huge advocate of it since then. One of the things that he realized that we're now basically breathing life into, one of the things Al realized was that this market is only going to grow to the extent that the sophisticated institutional investors can see that there are rules, that they know how to follow the rules, and that by investing in a fund or acquiring and rolling up funds, that there are ways to evaluate I like your term, the investment grade component, the capacity of any particular fund. And that would be true not just of the sophisticated institutional investors, that's true of any investor. Right? If you're going to put your money into something, you kind of want to know that it is doing what it needs to do to play by the rules, to avoid penalties, and potentially fatal penalties. So Al saw this very early on, kind of bided his time to see how the industry was going to play out, and decided at the end of 2021 that then was the time to start investing in a technology approach to compliance. So that was basically the birth of CapZone Analytics. That was the catalyst for our first funding activity. And that's also when I was brought on to start building the tech platform. You had mentioned some of my cybersecurity background. Part of this, honestly, Karen, part of the reason why I'm here is I have, through cybersecurity, I've spent so much of my life selling against compliance that it took me no imagination to understand that, to be the compliance provider that's an advantageous position because everybody needs compliance.
Yeah.
Right.
Yeah.
That being said, this opportunity zone space is a quirky space because it is relatively new itself. It's just a handful of years old. It's 5 years old by the law, and really kind of 3 years old, maybe not even 3 years old, because the final regulations came out at the end of in December of 2020. So we are still in this environment where there is very limited, especially for the size of the industry, very limited reporting required and filing required, very, very limited to be operative as a business or a fund in the opportunity zone space. Very limited reporting requirements and almost no oversight from the IRS because it's so new. So as a result, we have a generation of investors, of funds and businesses that are operating in the space. I'm just going to assume all with the best of intents, but with no real test of the actual rule. They're doing the best they can. They're running the business the best they can. But with respect to actually complying to the rules, I will tell you that my firsthand ringside, behind the curtains visibility into a number of our clients, it would suggest that if the IRS were to start knocking on some doors, thank you, there would be some funds and some businesses out there that would be scrambling to pull their documents together if they could even possibly do it, and would probably find themselves deficient in how they're tracking and managing their businesses to maintain the thresholds kind of prescribed within the OZ regulations. So that gives a little background on so we have been since the beginning of last year building the technology to really help the industry reach the next level, to help the industry. And so for our clients, we are onboarding their data at the fund level and the qualified opportunity zone business QOZB level, and helping them track and manage that over time, depending on their business model. That we may be capturing data semi-annually, we may be capturing it quarterly. For some of the more sophisticated businesses, like we're an operating business, a financial technology business, we have to capture our own data monthly, payroll data, assets, mobile assets, where those assets are going, to ensure that we can roll it up to proper reporting within the OZ regulations. So that's a background of where we're playing and what we're doing. Does that help?
Okay. Yeah. So, I want to put a pin in that, because I want to talk about some of that complexity of businesses and the difference in the types of investments, but like what the reporting, because like you mentioned payroll, right? And so I want to come back to that, but let's let our audience understand the diversity of the types of projects that you see as clients, but also that I've seen that have been, because I talked a lot at the beginning about, these economic deserts of inner cities, but where a lot of, like, surprisingly, like, and I mentioned, like, in Noonan, in this area that now have, these suburban homes and things like that being built there and whole stuff. But like, I've heard like a project, I forget the entrepreneur name and the name of the company, but it's one of the original early on commerce platforms up out of Detroit. It may ring a bell with you. The guy that had founded it had owned a basketball team or a minor league team, some sports team, sold it for hundreds of millions of dollars, I guess, something like that. Big old money, big capital gains on that. Turned around, Detroit partnered up with him and said, okay, we're going to, like, basically give you 100-year lease or work something out where you could buy this riverfront. And he was going to take that money because as an opportunity zone, and built hotels and jobs and a tech center and a live, work, play, and this whole development thing. So there was giant projects like that have done. I saw one through a real estate crowdfunding thing that was a similar thing up in North Carolina on the river. That was a live, work, play, and it said in an opportunity zone. So it's taking small dollar investments, which they're like, there's no real no reporting on the capital gains side of that necessarily, because it only took, you could put in $1,000 into this limited liability company that's part of a bigger thing there, but it said you would have this tax deferral as a benefit on that, right? And so and I'm gonna, and also I want to ask you about when it, like, they pay out dividends and stuff like that, because it's always been an area that's been confusing to me. And then you have like down a lot of universities. Turns out, a lot of these, particularly rural universities, they're in places that have lots of land around them. And I spoke at an economic conference pre-COVID down in Tampa, talking about how to use opportunity zones in those university areas, combined with the angel investors wanting to do that because they could develop, housing and for their, that was private dorm-like housing there. They could develop other types of business, the incubators and accelerators and stuff. So there's been a lot of different areas and different ways that states have recognized the need in their state and local leaders, because it was a bottoms up thing. So I want the audience to know that the variety of projects is huge. And this like the turnaround business kind of stuff. So like it's a manufacturing plant that may have been family owned, and there is a requirement, you would know this, and I think this is part of where the complexity of compliance is, because they had to have, so what is it? You tell me. There's a certain amount that went in that was an improvement factor. It had to have some percentage of improvement on it if they were buying a business. So let's dig into the differences of if it's a residential housing project, is there a difference when it's a hotel that's being built in the area, or a business that's being bought and being modernized in the area? Is there a difference in the measurement of how much capital is put in versus the initial piece of it? So let's talk about that first. What that piece of that first measurement that they have to track in a timeline? There's a timeline that it has to be done over, and is there any job requirement that was part of that?
Can you explain the entire code to me, Landon? There's so much in that question.
Well, let's just start with
Let's
the investment amount piece of it.
Yeah, so I always find it helpful to revert back to the why of this regulation. The IRS, this whole program post the Tax Cuts and Jobs Act was given to the IRS, which in and of itself is a unique dynamic here, because the IRS it wasn't given to HUD, which is where hub zones live. It wasn't given to one of the other agencies who normally do programs. It was given to the IRS. And that was, believe it or not, that ends up being a blessing. The IRS doesn't do programs. So here we are 5 years into it, and they still have not. I mean, it would have been easy to overburden this thing with all kinds of regulations and all kinds of stipulations. That hasn't happened. Now, the IRS did write its 544 pages of tax code that it released in 2020 that is now the operating business framework for the program. So they did dig in, and I've read all 544 pages a number of times. It's actually pretty, and I'm not a tax attorney or a tax geek. Maybe I am now, because I spend a lot of time in tax code. But what's fascinating is, here's what's clear. Here's what the IRS wants out of this program. They want, in return for the tax break, tax deferral on capital gains, what they want is jobs in an area, in these described areas. What they want is gross income being generated in an area. And what they want is money to move fast, right? Cash, they don't want people to be holding on to the cash. They want the cash to go to work. So they have written into the code things like capital gains event, as defined normally by the tax world, right? Outside of the OZ, capital gains event, you now have 180 days to invest in a fund. Okay, so that now the money's in a fund, but it's still not active in an opportunity zone. The fund can be anywhere. The fund upon investment, for every investment, by the way, the fund has, this ends up having some dynamics, but 6 to 12 months to put that money into an opportunity zone based business project. So the money has to move pretty quickly.
So from when they receive the money from the investor, or from when the fund closes and raising its full amount, or they don't really know?
It's from when every investment is received. So it kind of tracks the dollar down to the project.
Okay.
So you'll see some of the larger
complex. That's complex.
So it's pretty complex. There's a lot of tracking. So you'll see some of the larger funds, the ones that are raising 100 million or $500 million, they will have vintage funds. They'll do a 2023 fund. They'll open it. They'll close it in November, so that they can stop the clock on the last investment and know that they have projects that they can put money into. But that's one of the things is if you're an individual investor setting up your own fund because you want to do a 30-unit multifamily dwelling, that's a simple project. If you know the land exists for that project, you can see your way to having that happen. But there really does have to be two sides. The capital gains event, you can invest non-capital gains money. It is most attractive to capital gains holders. And then there has to be a project to put it into pretty quickly, because these things don't just turn up overnight. So
we would say you had to be shovel ready. That was our thing. You got to be shovel ready.
Basically shovel ready. Now, So hopefully that explains some of so the IRS wants jobs. It wants jobs that are going to generate income in particular areas.
That's right, because then they get the taxes from the regular old income taxes, which is another reason why it's okay to offset these taxes that they're not
Because
getting
they're
on the
the
capital
IRS,
gains.
yeah.
Right.
And keeping in mind that these are in opportunity zones that are distressed areas that would benefit not just from having rich people buy land or put a Four Seasons on the corner of this area, but they want the jobs and the income generated there. Okay. Now, there's many ways to do that. Real estate has dominated the industry thus far because it's a really neat, discrete project that you can point to that's in the area. And many of them don't have complex business models, right? Maybe an employee and a couple contractors that maintain the grounds. They're relatively easy to look at, see through, get operational, and know that there's a, double digit returns that are going to be made on it. They're discrete projects. So thus far, we've seen a lot.
That was really workforce housing kinds of projects. They were trying to get better housing in those areas too, right?
Yeah. So workforce housing has been one of them, even smaller projects, but also large hotels and hospitals. So here's the other cool thing about the Opportunity Zone program. It works without any boundaries or limitations. It works alongside any other program that's out there. So there are many projects that are taking advantage of new market tax credits and green renewable credits and other government offered benefits alongside the OZ with no boundaries or limitations whatsoever. Yeah. Okay. So it really is an opportunity to look at the Opportunity Zone program to say, if I'm going to be doing this here anyways, why wouldn't I set this up as an OZ? And we'll talk later about what it looks like to do it right so that you maintain all the benefits and don't find your way to be penalized out of all the benefits. But that was kind of the birth of that. That's the background and the framework upon which investors and operators have to be looking. Now, the breadth of the projects, while dominated by real estate, has been everything from movie studios to large high-rise office buildings to veterans housing to veterans clinics to workforce housing. I have college-age kids, so I've been on innumerable college visits, and the original requirements of the Opportunity Zones included things like employment levels and income levels, and a lot of university towns got caught up in this is an Opportunity Zone. So you'll go to many universities, and you'll see kind of that side of the street, which is you pull up your HUD map. I mean, there's a number of them, but I use the HUD map to show where the Opportunity Zone is. It'll light up pink on that side, and invariably you'll see 3-year-old buildings that are student housing, which are spectacular investments, fully utilized all the time, relatively inexpensive. You'll see that in almost every university town that you go to. And I'll say this from firsthand experience, right? So, but the breadth of projects is, I like to say, it's just getting started because real estate has been so attractive and so easy to think of because it is a place-based investment program. But we're a good example of, we're not a real estate project. CapZone Analytics is a software company. We're an operating software company. And we intend to make a lot more than that low double digits returns. Not only is that capital gains tax deferred or avoided, but all of the net income made in the business through 2046 is also treated similarly within the Opportunity Zone program. So to run an operating business, which is a warehouse, a data center, a manufacturing facility, a software company, a startup, we're starting to see those increase significantly. And with new legislation, I believe that's going to spike significantly for the Opportunity Zone program.
So you can invest in a startup business in those areas, not necessarily a turnaround business.
So here's the thing. It does have to be so as far as an operating business, it can be, because in an operating business that doesn't own the building, then you're just talking about the lease. The lease counts as good property towards your Opportunity Zone operating model. So yeah, it ends up being pretty straightforward that way, as long as the business is going to provide the fund and the necessary information, like payroll information, like gross income information, and operate in the zone. Then, like we are, then you can absolutely invest in a business set up as an Opportunity Zone business.
Yeah, we had up by one of our airports, a little regional airport. They turned one of the old abandoned office buildings into an incubator with
Okay.
a fund
Perfect.
to invest in the companies that were going to be coming in there, kind of a deal, and a movie fund as well. They were trying to do that. So,
Interesting. So let
so,
me take that
so
as an
is there a
example just 1
different?
second.
Okay, go ahead. Mhm.
Because you asked about improvements and so forth, right? So in that case, if there's an abandoned building, if there's an existing building on the land, then what the Opportunity Zone program requires is that you invest in improvements to that building that
Right.
equal 100% of the value of the building asset on the land. So it
What
does
you paid,
require
what you paid for it, or what you paid for it? Is that what they
what you
established
paid
the
for,
ads?
what you paid
Okay,
for. Yep.
so
So
it's
there is
100%.
100% of the value of the building in the acquisition. So there is development required. You're right. They want improvements in the space. That's another thing that the IRS is going to
Yeah.
want, investments and improvements. If it's an original use situation where there's no building on it, that requirement does not exist, obviously. They're expecting that you're going to build upon the thing, which is how you're going to generate income and jobs, which is a
Yeah.
requirement of the program. But
Right.
so original use, no substantial improvement. But if there's a building there, they're expecting you to substantially improve it. So there's a kind of a 30-month development window to track and manage the development dollars. So on the backside of that, you can show that the value of that asset was invested in to improve it.
And does that include when they went into a place and then they tore it, leveled it, and built something brand new? The cost of leveling it is
Yeah.
calculates into that.
Yep. Absolutely. Absolutely.
And so
Demolition.
and then like if it's something, if they're paying out dividends or something on the investment, does it just go back into the fund for future, or does the investor get the benefit of the dividends, but they don't have to pay taxes on it, or do they have to wait till the end? Seems like that would be a complex area too.
So that would be dollars exiting the program, and depending upon the timing of how long those dollars had been in there, there would be a necessary calculation. You can pay dividends. I honestly don't know of any investments that are paying dividends. It seems to be most attractive for funds and businesses to have a long-term hold situation,
Yeah.
as opposed to paying out dividends.
So
And so
so the magic 10-year mark that they had to hold that in order to avoid any future because the deferral of the capital gains had two numbers, right? There was one that was full 10 years, and then one that was like 7 years or something, and it was less, right?
Yep.
So there's a
step
trigger.
up basis there's a step up basis in benefits. You get the full benefit at 10 years, 7 years starts the benefit. There's been operating businesses that have grown so significantly that they couldn't stay within the program and have exited, at year 3. And you can absolutely do that. There's a math calculation to rolling back the tax advantages of the investors at the time. There's a cost to exiting the program, but it can absolutely be done. And it's that part is actually not
You
that
just said
complicated.
something there. They did so well, they had to exit the program. What does that mean?
Yeah. Well, so so in the program, you're either going to continue to reinvest the income generated in your
Okay.
business, or operate within opportunity zones. If you're adding 100 employees every couple months, your office space and your locations are growing such that there's a potential strategic reason why you're going to say, we need to be overseas, or out of the country or outside of opportunity zones. And it no longer makes sense. And it's a rare situation, but I'm just highlighting that they're exiting the program. There's no kind of illegality to exiting the program. There is a prescribed way to exit the program
Yeah.
prior
Okay.
to 10 years. Full benefits, 10 years. And then even beyond then, there can be purchases and selling of shares within an opportunity zone fund.
So if they've invested in a fund, because I know there was a point where, like let's say a family office had their own, they'd had this own transaction, and they wanted to go and they could qualify themselves as a qualified opportunity, like their own investment. And then there were these pooled funds like you described. And so when there's a kind of income that's being generated, like, let's say it is affordable housing and it's or lease to own. Sometimes there's been programs where they do the lease to own, or it's a And so they set it up where it's like at least to own 10 years. So they would be outside the window, and then there would be some kind of a bubble to purchase it or
Yep.
something. And then they would have, so that money, do most of the funds, in order to keep it simple, they put the money back into the fund or into a second fund. And then that fund then goes and invests, and it doesn't have a capital gains basis. It just has a profit, I guess, that would have a different kind, but it being put back in there. So is that how some of them have done it, where they just have rolled it into another fund and in order to, kind of kick the can down the road till the magic date of 2027? Is it still 2027 is the magic date, or have they deferred it to 2029 already?
No, it is.
The 10 years.
So let me put a pin in that, and I'll come back to that part of it,
Okay.
what the end date is and what it means. You can roll income generated back into the existing project through improvements or expansions. That happens a lot. You can also take that money and invest it into another fund, and realize we are 5 years into this thing.
I know, it's amazing.
So we're, and literally nothing has been tested yet in IRS tax court,
Sure.
or in the inquiry process. So we are in the season right now of all these things, and all these nuances are getting figured out literally as we speak, as funds are getting to be 5 years, 2 years operational, making a significant amount of money. What can and should we do with this to optimize the performance of our fund? So part of that is a stay tuned, and part of certainly the program allows for reinvestment in existing operations or a new fund. Now the 2026 part. So the current regulations indicate that December 31st, 2026 is the last date that new capital gains can be invested into a new qualified opportunity fund. As it stands now, there has been some legislation that has kind of expired, and there's expected, just because the popularity in your intro, you highlighted really well the popularity. It is bipartisan. Republicans love it, Democrats love it. It's bicameral. The mayors love it, the towns love it. So there really is no inertia working against this program. We would need a bill passed. That may be the only inertia working against it, depending upon if this particular Congress can pass bills. But pretty much anything that ends up making its way through the system is highly likely to include an extension to that 2026 for the original OZ. But for right now, it ends in 2026. Now, the program goes until 2047.
Okay.
So any existing fund can operate and can recycle their gains, just like we described, into these funds. And we call that the secondary market, because existing shareholders can sell their shares in existing funds for new gain investors to invest into the funds. So while it's not a new fund, I can't set up any new funds, you can sell. There's a trading that will happen and can happen for new gains. New capital gains can be invested into a fund and start the clock on their gains for the 10-year period for the capital gains benefit, for the deferred tax benefit.
That's as of 2026, because they can't
post
create
2026
new funds.
going.
Okay.
Yeah.
Wow,
So
I did not know that.
So what myth one busted is the program dies in 2026. It does not. If nothing changes, no new funds can be created, but these programs continue on. Our estimate is there's 20,000 active funds out there right now. Nobody has perfect visibility because the IRS is the only one that has it, and they don't publish this information. Our estimate is 20,000 funds. Many of them, single investor, single fund, single asset. Some of them more complex. But every one of those funds can continue to operate and make money and defer income taxes, the taxes on their income, through 2046 or 2047 as it stands right now.
Okay, so because that was like a big thing. I had been wondering, and I did not know about the 2047. I thought it was 2020. I thought it was 10 years after the 2017. But you said you have to invest by 2026. On that. So anyway, the question for new funds. Yeah. So I had this fear that we would have a major flood of sales of commercial properties and things in 2027, because that would be when IRS was going to come knocking for your capital gains, and they didn't want to have phantom taxes because they didn't have, you know what I mean? They would have to liquidate in order to do that. So none of that. That mythological fear I had in my head is not a risk at all.
It is not a risk, except I will pick on one of your points. And for those who are invested in the opportunity zones, in the opportunity zone program, upon maturation of their fund, of their investment, we have detected signals. I mean, I am not plugged into any special sources in the IRS, but we have detected signals that if they don't pick their head up and start asking questions and start doing kind of fuller scale audits of funds and investors, that's when they're going to be really paying attention at the maturation of the funds, because that's where they will, they've already deferred taxes up to that point for potentially 10 years. But this is where the real benefits given back to the investor. And that is where I wouldn't be surprised to see some kind of an exit reporting criteria put in place in order to affirm that the rules were followed along the way.
And that maturation is based off of the date 2026, not off of a 10-year magical 10-year number.
So, I mean, it's measured off of when the investor put their money into the fund. So the fund has its own liability, and its liability really is, so this is important. This is kind of an interesting.
Yeah.
Here's the liability map of the industry. The fund itself, when they sign their original IRS form 8996, there's a little box down there that they get to check that says, I ascertain that the information that I'm gathering for my fund operation is sufficient and substantial to follow the rules. They're signing that just like a CFO would sign the financial statements at the end of the year for a public company. That's the signature on the 8996. So they're responsible for the paperwork and the data that allows them to certify at the end of every year, yeah, we did the thing.
Okay.
That's their liability. All the other liability gets pressed back to the investors. So what we've seen that has already happened is the investors' returns get audited. And this is something that not many people know. The investors' returns get audited when a fund is determined to be not operating properly or hasn't maintained their proper operation within the within the opportunity zone program. The investors' returns get inspected, get audited. And this is not a popular move for anybody, much less high net worth individuals who are oftentimes investing in these. So this is one of the reasons for us being here, is to ensure that these funds are operating properly.
Yeah. Okay, so let's get into some of those risks on the compliance side, because we talked about exits, and that kind of a thing, or this magic date in the 10-year. But you mentioned your own, reporting your payroll and all that kind of stuff. And so when somebody's doing the different types of projects, it's a business or it's a development or it's they're running it. Yeah. So is that a requirement of all the time? So like the fund is reporting their payroll of the fund managers, or describe some of those kinds of things that the IRS is going to be looking at when it looks at elements, if you will, of what should be taxed or what should be tracked, or that kind of stuff.
There's very, very, I don't want to say rudimentary is not the right word, high level reporting requirements from the IRS standpoint. There's this form 8996. You can go look it up. I think it's got 16 fields on it, and there's not much to it. It asks for the value of your assets. Did you satisfy the 90-10 rule? There's these rules that go along with the Opportunity Zone program. Did you satisfy the 90-10 rule? And this 8996 has to be filed every year at the QOZF level, every year that they're in operation. The interesting dynamic is that doesn't really even scratch the surface on all the rules that it must follow in order to meet that criteria. So there are things like the gross income test, the 50-50 gross income test, where 50%, as the law specifies, 50% of the gross income of that business, each business within a fund has to treat it independently and then roll up to the fund performance. But each business must have 50% of its gross income generated in the zone.
Oh,
So
okay.
you can't just have a building just with a mailing address and then have your nail technicians running around town generating income outside of the zone and not account for it. 50% of the gross income has to be generated in the zone. And it gets complicated when you talk about mobile people, mobile assets. A landscaping company is one of the examples that the IRS holds up in their literally in the OZ regulations. So then you get it. So as you can see, you peel one layer off 50% of the gross income. Okay, so let me calculate that. Are we talking about 50% by hours or by dollars? And the answer is yes. So for instance, our software will, because it's not tested, it's not specified, nor is it tested. So it's not clear. So for instance, our platform will measure it by both dollars and by hours to ensure that should that question be answered, we're helping our clients to track and manage it. Then there's this concept of, well, what if my people are leaving and generating income because we're a service-based business that is mobile? That there's stipulations for that in the program, but that have to be tracked and managed. So there's a gross income test. And then there's a payroll test where 70% of your payroll has to be generated in the zone too. So there is these layers of thresholds that must be managed and tracked and managed in order to ensure that you can file that form at the end of the year that says, yes, we did the thing. And so those are the rules that I'm starting to describe. Those are the rules. And we believe that there's around 200 of these rules in the zone, in the opportunity zone regulations, that will end up programming into our analytics engine to help track and manage these things so that they're
So when you talk about, they're looking at where the activity that created the revenue is done, not even if it's paid back at the central location, because it seems like that would be something with a manufacturing facility because they're selling retail or they're making ice cream and they're sending it out and they're generating the transaction somewhere else. Right? Isn't that the same? I mean, if the job is to go do something, but you come back and your car is here or whatever, you're still an employee of this company generating revenue for this company. So I'm a little confused as to that.
Super simple if your business is a parking lot, or super simple if you have a leasing office and you're leasing 30 units, because everything really is happening within those four walls. That this is part of the reason why real estate is attractive, because it fits neatly. Less neat is the example of the landscaping company. So you just have to track where the assets of the organization are so that you can claim we're a services-based business. We've been tracking this, and we are 50. We satisfy the 50% rule.
Okay, because I was going to say it seems unrealistic to say that a business has to generate every little thing like a grocery store there, versus a manufacturing business or something along those lines that generates revenue all over the place. Even a SaaS software, right? You got clients all over the place that are paying their bills there, so that's okay. So there is some common sense there. They just want to know how the revenue is generated on that kind of stuff. So okay, so then you have to track all of that. And then so do they consider services transactions, rental transactions, all of that stuff is just a transaction that generates income that goes back into what would be the fund, because they're not paying out any dividends on that stuff. So so they're just like stockpiling that money into the fund.
Reinvesting back into the business. I mean, easier for a hypergrowth software business. Again, we're only 2 years into it, but easy for a hypergrowth software business who is largely going to run at a loss for a period of time anyways. But to, even when we turn the corner, to be able to reinvest back into the program or into our company as we add people and potentially locations.
Okay, so that's a red flag, if you will, is the tracking how the income is generated. Any other ones that stand out that that people don't think about? You find all the time that people are going like, "Oh, I never thought of that one."
I mean, there's an endless number of stories of the intricacies of what can be done. I mean, one of the things that has tripped up a few clients, but just by the nature of their business, is the OZ program does not allow sin businesses, or at least it limits sin businesses to be operating within their projects, the QOZBs. So the retail on the bottom, residences on top. If there's a liquor store on the bottom, for instance, or a grocery store that sells beer and wine, it just has to be less than 10% of the total gross income generated by the project. To track it and manage it is all that's required. And obviously, you might run into a problem if you're trying to build a casino in an opportunity zone and taking advantage of that. That would be tough to show it's less than 10% of income. But things like that, there's intricacies of the program that are kind of case by case basis. But for the most part, it can be very straightforward. And I will tip my hat to the IRS when they wrote this. It is mentioned at least a handful of times throughout these 544 pages that literally, if you're operating in the spirit of the program, you will be given an incredible amount of grace. They have built into the program a mulligan. So if you catch yourself and self-report, hey, we kind of messed up on this thing. Are we good? And we've seen it time and time again. The IRS says, you're good. We see you've mitigated the situation and you get it going forward.
Yeah.
And that really should be an encouragement and a massive green flag to Opportunity Zone program. As complex as it is, the IRS wants it to work and is operating under the assumption that the investors in the space also want it to work. So
yeah,
I don't
that's
want to leave a
encouraging.
ton of fear and doubt within the
Yeah.
investor community.
So I know I mean, I could probably ask you another 20 questions on this, but I appreciate you taking the time to share your insights with our audience. So as we start to wrap up, what would be something like if somebody's sitting here listening and they have put their money into a fund, what would be you should ask yourself, have you received this report, or have you received this information, or whatever have you done, because you talked about quarterly reports. They're not necessarily for the government. That should be for the investors, right? So what is the kind of thing that they should be going, I need to double check and make sure, because it would be sort of trickle down. I mean, it's not just the fund manager that gets penalized for this. It's going to be the investors in the funds if things aren't done properly, right? So what should they should be asking themselves to say, like, I need to double check what's happening on the compliance side.
Yeah. So if you're creating the picture of what should an aspirational investor ask a fund to evaluate whether it's doing what it should do, I would recommend that they ask the fund how they are capturing their good property calculations. Good property is really the highest level threshold of the operation of a fund. Underneath good property is the definition of all those other thresholds, the 50-50, the 70-30. So this is the kind of layer upon layer of the onion that all rolled up to, is the property, quote unquote, business property, we're a property as an operating business, is your property good property, and how are you calculating that? And you'll get either the blank stare, potential red flag, or the pretty well laid out answer of our accounting system is set up to do these things. They're oftentimes done very manually these days, just because of the way the program has been built up. And you start with one fund, and next thing you know, you've got 5 funds. So the clients that we're servicing have reached the human limits of their ability to track and manage all this data, and are grateful for the ability to offset that with a technology solution. Simple projects can still absolutely manage it with the spreadsheet, as long as they truly understand how they're rolling up to that final end of year certification for good property within their
End of year final certification being 2026.
2026 being the last time that
okay, so every year they have to be doing something.
Every year that the fund operates, even beyond 2026, they still have to certify that they're operating within the OZ program.
And they certify that to the IRS?
Yep, right in their tax filing, right in the funds filing.
Okay.
And then the individual investor has to continue to claim that they've deferred the taxes. Yeah.
So now accountants and CPAs usually do these tax things. So are they just basically doing the filings and just trusting, kind of like you do, oh, they've given me all the information, Mr. Business or Mr. Fund Manager, and I'm just filing. I'm not trying to avoid or,
You got
or
it.
guide you on what you need. So like, why is it that they need to another level of scrutiny or like data capture? Why is it that, is it, you got any, I don't want to say accountants don't do their job, but I just like
No, but it's a brilliant question because I mean there is a community, and it's a small community of accountants and attorneys who are incredibly proficient, who are experts in the OZ space, who have built practices in opportunity
okay.
zones.
Okay.
And then there's the rest of the profession, incredible in what they do, and what in the simplest form, when they have a client who is in opportunity zones, they will look at the form required at the end of the year with the 16 fields, fill it out to the best of their ability as per the information given to their client from their clients, and have checked the box from the IRS filing standpoint, not necessarily having followed all the rules, not through malice, but just through this disconnect between the sophistication and complexity of the code, of the
Yeah.
regulations of the law, and what the IRS requires to file at the end
Yeah.
of the year. Yeah.
That's where the mulligans come in.
That's where the mulligans come in, for those paying attention. And before we break, there is just one thing I would recommend that potential investors keep their eye on is new regulation. I mean, there is the myth about the program dying in 2026. That's a myth. It extends beyond 2026, and you can invest. There's also highly likely to be new regulation that extends that. And there's even new regulation that really just popped onto the scene 2 weeks ago that
Okay.
opens up, and this is it was instituted by the chairman of the House Ways and Means Committee, and I've been told by people who know about these things that basically means that we will see this as a law that adds 1,500 new zones in rural areas.
Oh.
Okay. And extends investment to 2032 and requires reporting for all costs, rural or otherwise. And let me explain what that means, because this is one of the things we are most excited about. By opening up 1,500 new zones in rural areas, that is not going to be necessarily attractive to the real estate residential 30-unit multifamily dwelling units like the original regulations are, but it will be incredibly interesting to the institutional manufacturing facilities. That basically completes, by the way, the coverage of all military bases in the United States. Half of them were covered in the original zone law. This pretty much covers the other half. And all the I mean, so now you're hitting on some big sectors like distribution warehouses and data centers, which are just hot market segments. So these are hot projects in any rate, but the ability to fund some of those and invest in some of those through the Opportunity Zone program, it's expected that these large projects, these large sophisticated projects, are going to be the ones that end up taking real advantage of those new rural opportunity zones that are coming up, whether it be the DoD or the Amazons of the world and Facebooks of the world with the large data centers. So we're watching that closely, and we believe when that passes, it'll kind of become alive in 2024.
Yeah. Well, that's tied very well into the semiconductor chip, thing that was passed last year or the year before, the CHIPS Act, because we need to bring that kind of manufacturing back into the US, and robotics and all that kind of stuff. So that's going to be, we need to start manufacturing solar panels. We don't manufacture those here. We need to manufacture steel here, so that's going to be really encouraging because of what I mentioned earlier about the deindustrialization of some of those rural communities, particularly out in the Midwest and in that area. That's encouraging. I had seen, I think there's some rumblings of some additional IRS regulations or compliance, because when I was searching on, just looking to see, look up some stuff, I saw something from a 2022 and it had like 10 different legislatures signed on to this one that was trying to push it through, and it didn't get through then, but they were like still trying or something like that. So yeah, I'm
So
sure,
the replacement fast track, if anybody is a geek like out there like me, you can look up HR 3937 is the bill that is set up and it's called the Small Business Jobs Act. You can search for it that way too. 3937 Small Business Jobs Act that lays out these three new components of the extension of the program to rural OZs, the extension to 2032, which is an important 6 years of investment, and then rigorous reporting requirements for all operating funds in OZ. So
great.
Watch this space. Watch this space.
Yeah. So, all right, folks, the thing is that if you are a family office and you've just been doing this on your own and you've been invested in funds all along, I think the ones that are probably safe are your big funds. Because when I was working with a fund trying to identify projects when this thing first had started, their first thing was, oh, and we're with this accounting firm that knows this stuff. So they were starting to the point at the very beginning, to mitigate the risk and the due diligence, because they had those relationships established. But other ones, because they're, like you said, there's a lot of funds out there, and a lot of them just sort of popped up, jumping money, trying to, figure out a way to make more money. And, they may not understand all of the nuances of these regulations. And so you as an investor, or if you were directly doing your own operating zone investment, or if you are part of a family office, or just something, or a small kind of fund where a few people pulled it together, you really need to be looking at this stuff. You need to give Landon a call. The website again is CapZoneAnalytics.com. It's in the show notes. And really check it out, because this could be like, so what's the penalty? What do you think will happen? Let's just talk about the dark horse in the room, right? So if people make the mistake, if they are egregious, not just a mulligan, do they have potential to have to pay all the capital gains on this, when the exit happens, or not be able to deduct their, deferred capital gains? They could really have a huge tax penalty. That's really is the biggest potential risk, right?
So I don't want to freak people out by this, but you look at 3937, which upgrades the penalties and specifies them. It's for a business for a fund over $10 million. It's $500 a day up to $250,000 in penalties, plus the rollback of the tax deferral. That's in a nuclear situation where they really busted it, right? Rollback of the tax deferral, a disqualification of the qualified opportunity fund. And by the way, you still own those projects, so it's not like those projects go away. They were good projects, hopefully, but it gets pretty onerous pretty quickly. And I believe that is also a signal from the IRS to say we're going to start paying attention to this, and we've now specified the teeth that we can operate within. Again, I don't have any special information, but to me, that's a signal that they intend to kind of flex that muscle a little bit in order to ensure that the program is working the way that they originally designed.
Yeah, great. All right. Before you give me a dad joke, anything you want to do to wrap up here?
I am amazed at how much we covered in such a short amount of time. It is a complex space, and I do encourage the investors out there to keep a look at this, because there's nothing quite like the Opportunity Zone program from an pure investment standpoint, to take your capital gains, you keep your basis, take your capital gains and reinvest it. But also, it really is. I mean, I am here because I believe in the program. I'm not just building software for the sake of software. And I've seen with my own eyes the invigoration that this private capital can have into the areas that have been defined as opportunity zones. They did that really well. And there's some anomalies, of course, 87, 68. You're going to make a few mistakes. For the most part, they got them right. They've corrected what they didn't get right. And now they're adding these rural zones. And impact is really being made every day through the $200 billion that is currently invested in the program. So I'm excited to tell these stories and to track and measure the impact that these investments are having. So I get excited about it.
Yeah. Oh yeah. I I just have economics kind of running through my veins. And so whenever I see a really good program that does, I mean, it hits so many different cylinders, right?
does.
I mean, it's like, is that the right way? Pistons? I don't know. It's just hitting all the right
All
spots.
the pistons are firing.
Yeah, because it's, housing, jobs, income,
Community
innovation,
development. Yeah.
all of these things. And the other thing that I read, like, it's not like some places where it's just sort of there and it happens. The ripple effect that it has in the next door communities, like right outside, you
Yeah.
know, uh, unlike, I mean, like we talked about red line in the beginning, it killed what happened in, but it also had a negative impact all around it. Well, this is having the exact opposite. It's, nurturing and growing what's in, but also having a positive impact on around it. So that's it's just, it's good all around. And I'm so glad I met you, that I could have you on the show to clarify and talk about this stuff, because this has been really informative for me, and I'm sure for our audience. All right. So have you thought of your dad joke yet? So you must have, like right off the tip of your head, you'd
This
like
is
advertise yourself that way,
the toughest, perhaps the toughest question of the day. I do love a good dad joke, and I have a significant database of jokes. So we're a qualified opportunity zone business. We are based in an opportunity zone just outside of Dallas, Texas. Arguably the home base of country music. So my question for you, having some hometown knowledge of this, how do you get the attention of a country music girl?
Spurs.
Tractor, of course, obviously. I mean, sorry, it's like it never ends. I've lost
That's
relations
good.
over these kind of things, but
That's
it's
good. And maybe
fun.
that I keep forgetting that they're always supposed to be like a play on words like that. I'm a good laugher. I'm not a good joker. So
Okay, so we're well matched.
all right. So thank you very much, Landon, for being on the Compassionate Capitalist show, and very much looking forward to staying in touch and seeing how this go, and probably do an update in a little while or something, right? So with that, I'll tell everybody onwards and upwards. Thank you. Have a great day.